Let's imagine we've identified the best A1 stocks using the famous Roger Montgomery method of assessing intrinsic value and comparing them to their market prices. We next have to work out how we buy these stocks. That is, if you had, say, 10 stocks and you had $100,000 to invest, do we slam 10 grand on each one? To answer this challenging question, we have analyst and valuable expert Roger Montgomery in the studio. How are you, Roger?
Nice to be back. I'm well.
Mate, I've got to say to you, pronouncing Value.able, is it supposed to be valuable? There's a dot.
You're talking about the title of my book, aren't you? There's a dot. There's a coin. There's a dollar coin there.
But there's no pronunciation.
Value.able. Value.able. It enables you to value companies.
Yeah, I know what it means, but just actually saying it, it reads.
It's a play
really
on the word
well.
valuable.
Yeah.
Valuable, Value.able.
Yeah. When I say valuable, it doesn't actually have the emphasis, so we'll go Value.able.
Yes.
Rather than we go for
Thanks.
A.
Do you know how I came up with the title of the book?
No, but tell me.
It took me about 6 months. I couldn't work out a title. The book was almost finished.
Yeah.
And I still didn't have a title. And I said to my wife at the time, I said, you know what? I'm just going to get the dictionary out. Whatever page I turn it to, that'll be the title of the book. And she said, that's ridiculous. There's no way that's going to work. And I opened it up, and the first word I looked at was invaluable. And I thought, invaluable, valuable, Value.able, valuable. I've got it. And she couldn't believe it.
No.
She couldn't believe it.
And you said,
true story.
You said my then wife. You've only got one wife, haven't you?
My wife then said...
You heard this.
Yes.
Hey,
no,
all right.
only planning on having one.
That's right. Now, A1 stocks, just for our viewers who might have forgot, get us, you were saying before the show, there's about 56...
Yeah, there's 56 out of 2,000 odd companies. There are 56 that I reckon are A1s using the quantitative process we use to rank every company from A1 down to C5. There's 56 A1s. Yeah. Not all of them are cheap presently, which is unfortunate because what you'd love to do is just buy only A1 businesses and only at discounts to intrinsic value.
With the share price up down here and the intrinsic value up there.
And look, quite frankly, the whole point of ranking companies from A1 to C5 is about sleeping at night. A1 businesses have the lowest probability of bad things happening to them. So we've identified a group of factors, a group of characteristics or if you like, fundamental ratios that we measure at a point in time and longitudinally as well. So they change over time. And we've identified this bunch, there's about 38, 39 ratios, and in combination they are very good at predicting default or capital raisings or going
and when you
bankrupt.
say ratios, for people to understand, by ratio, they're measures you're putting on the
KPIs.
company.
Anyone who's watching the program runs their own business. Key performance
indicators,
numbers.
And so they actually measure the worth of the company, all different aspects of it as well.
Well, it's not only the value. In fact, the value is a separate thing. We put the value over there. First, we look for quality businesses. And we want to
what's it worth? I meant that, not the actual value.
Yeah, so we're looking for great quality first. And then when we find great quality, then we go and value them. And this leads us to the next question about how much money do you put into these businesses.
Now, before you do it, just for those people out there who always love you to recap, what are some of the big names or the names that you recall that are A1 companies?
Yeah, OK, so for example, a company like Cochlear is an A1 business. CSL would be an A1 business. Out of the banks, I think the CBA is an A1, although it might be an A2. In the retail space, businesses like the Reject Shop have previously been A1s. Oriton is an A1. JB Hi-Fi has been an A1. They won't always be A1s, and every 6 months we review those rankings, and they change over time. What's interesting, ARB. The blokes stock.
I was trying to remember for some reason.
I think what we need to do from now on is just find a reason why we should mention that stock every time I come on the program. So it's been an A1 or an A2 for 10 years. They've been running that business now for 36 years.
A1?
It's close. I think it might be an A2.
Okay, right. Okay, so we've covered some names. Now, we've got 100 grand just for simplicity, and we want to buy 10 stocks.
Sure.
So a lot of people would say, well, put 10 grand on each. What would you say?
Well, you could do that, but what I actually do is I actually look at the relationship between the price and the value. So what I do is I say to myself, right, well, let's say there were 10 A1 companies. We've got to take a step back, actually. Let me just... Something else your question didn't allude to.
You're invited on the show. You can step back if you want to.
Let me take a step back. The greatest benefit of diversification, so the greatest benefit from diversifying, from adding an additional stock to your portfolio, occurs from going from one stock to two stocks. So as you add the second stock, you get a huge decrease in volatility of your portfolio, provided that they've not correlated. So as long as you don't buy two banks, you know, or two Woolies and Coles, or Myer and David Jones, you get a big. So if you buy a bank and maybe a mining stock or something, actually the correlation of those is pretty close, but at the moment, but you get a big drop in volatility of your portfolio, and therefore the traditional measure of risk. Yeah, exactly. And that keeps dropping substantially till you get to about the 10th, 12th stock in the portfolio. And then, so if you imagine a curve where you've got the number of stocks on the horizontal axis, and then you've got your volatility of your portfolio or your risk measure on the vertical axis, well, you've got a curve that drops away like that. So as you add more stocks, that curve comes down quite substantially. Higher risk because you've only got one stock, and then low risk. But then what happens? It flattens out.
So less value.
Well, there's less benefit in adding the 52nd stock and the 53rd stock. In fact, most of the benefit comes between 10 and 20 companies. So that's where most of the benefit is.
And a lot of people say 20 stocks means you've got a 5% exposure to any one company if you divide up your money evenly.
But just remember, you could buy, and this is why that quality scores are so important, these A1s to C5s, is because if you had, it doesn't matter how many bad stocks you get, you know, if you get 25 bad stocks, then your portfolio is no less risky than if you had two bad stocks. So you want to have good companies. I think it was Charlie Munger, Buffett's right-hand man, who said, if you mix raisins with turds, they're still... Sorry about this, but if he said, I'm quoting, if you mix raisins with turds, they're still turds. So, and I thought it was a good observation.
It's the kind of logic you expect in Omaha.
Yeah, correct, from Omaha. But he lives in Pasadena, actually. But so if you have bad stocks, it doesn't matter how many you get, you're not getting any benefit from diversification. And the bigger
you might live in Pasadena, but that comes from Omaha, that kind of thing.
Oh, you reckon?
I think so.
Right.
Go on.
Fair enough. So the less the correlation between the stocks, the greater the drop from adding the additional stocks. But it doesn't matter what the correlation is, the greatest benefit is between 10 and 20 stocks. After 20, you're getting less and less. In fact, the cost of adding the additional stock is greater than the benefit you get from the additional diversification. So somewhere around that, 10 to 20 stocks is about the right number. So we've taken a step back, let's take a step forward now.
Go.
You've got $100,000, you've said, OK, 10, 15 companies. What I do is I don't equally weight them. If they're all A1 companies and they're all at varying discounts to intrinsic value, I would weight them in my portfolio based on how far they are from that intrinsic value. So the further they are away, given that they're all A1s, I would more heavily weight the bigger discounts. So the companies that have the greatest discount, therefore the highest internal rate of return potential, I'd want to have the most in those. You focus on great quality businesses when they're cheap, and you weight the ones that give you the best opportunity. Now, how much should you have in one stock? You know, if I was managing my own portfolio, and I don't now, I have all of my money in the fund, so I don't want to have any conflicts of interest. But if I was managing my own portfolio, I would probably only have 6 or 7 companies in that portfolio, and I'd be quite prepared to have 20% of the portfolio in one stock. But managing money professionally, I don't do that, and I limit my initial positions to about 7.5%. But I'll let them grow to as much as 20% of the portfolio, and at that point I don't let them grow any more than that, and I start taking profits.
So it's possible a stock where the difference between the market price and intrinsic value is quite big, you can actually have 20% of that stock.
Well, if there's a 50% discount,
encourage you in.
If the price is at a 50% discount to intrinsic value, well, for it to get to intrinsic value, it's going to double. I'm going to make 100% of my money. So the weighting will go, assuming nothing else changes in the portfolio, the weighting of that stock will go from 7.5% to 15% of the portfolio. So now it's quite a substantial part of the portfolio.
As always, Roger, old man time is against us.
No problem.
And
we'll be back in a fortnight.
Time goes too quickly when I enjoy myself with you, mate.
Thanks.
OK, see you in a fortnight's time.